Founders tell themselves stories all the time. I'm often hearing them talk about the picture they have of how their company is going to grow. They have a brilliant idea, they put together a prototype, get some money from friends and family, and within a couple of months, they're ready to go to angels to raise some money to build that first real version of the product. And then 6 months later, they're going to go out and get a $5 million A round that's going to make their company take off. And the problem is usually in that last step. It's not happening for a lot of the companies I'm looking at. Understanding why and what you can do about it is going to be critical to the success of your business. Hi, I'm Lance, and welcome to Feel the Boot. When I get together with entrepreneurs or angel investors, one of the topics that comes up over and over is A rounds. They're just not happening for most of the companies that I see. And this is causing a huge problem. The business models assume that you're going to hit certain milestones and be able to take off. The fact that they're not happening is causing some real crises for these businesses. I'm working with a couple of different companies right now that have a product, have revenues, have happy customers, and are growing. They're either break even or maybe even a bit profitable. And yet, they're taking years to get that A round if they ever do. Part of the problem here is structural. The funds that are putting in these A rounds are getting bigger. They have more money to deploy, and their expectations for the companies that they invest in are getting higher. And the reason is fairly simple. When a fund has $10 million to invest, they can then maybe make 10 investments out of that fund of, say, $1 million each. But if they've got $100 million or $1 billion or many billions of dollars to invest, suddenly investing $1 million or $5 million doesn't make any economic sense for them because the amount of work that they need to do is exactly the same. Same due diligence, same legal paperwork to invest a small amount of money as a large. But they only have so many partners, and the partners only have so much time in the day. So when you've got a big fund, you have a huge incentive to only make huge investments. And right now it looks like the A round funds really don't want to deploy less than about $10, $15 million. Those $5 million and less rounds just don't exist, at least with the venture capital funds. Now, there are some seed round funds that exist and some, quote, angel funds, but even those tend to be asking for more, and they're somewhat few and far between. There seem to be two kinds of companies that are doing well at getting A rounds, and the first is companies with an unfair advantage. That could be because the founder has a previous successful exit. They've been able to make a lot of money for their last investors, and that makes the next investors much more likely to jump on board. It could be that they've just built a fantastic team. It's all A-listers. Everyone has experience in the space and knows what they're doing. And the mere fact that you've been able to pull together this all-star team speaks really well for the company and the management, and again, makes investment more likely. Finally, you might have really well-connected investors and advisors, people who have a track record of success, have the money to bankroll the company entirely if need be, and likely know people in these venture capital firms and can provide that warm, if not overtly friendly introduction right into those organizations. So that's one way that people are getting A rounds now. If you don't happen to be one of these people with a tremendously successful exit, or the dream team, or investors who know everyone in the venture capital firms, the other path to success seems to be the hockey stick. You need to be growing like crazy. Not at 30% a year, which many people would think is a reasonable growth rate, but at 30% per month. You've got to be taking off and have good unit economies, profit margins, and everything else. If you can do that, then the VCs will beat a path to your door. But if you're growing at 30% a month and you're profitable, you've got to wonder, why do you want the money from these venture capitalists in the first place? It can be fuel to pour on the fire, but it can also just be an unnecessary dilution and distraction. So what are people doing instead if they can't raise that A round? What I'm seeing is they're going through multiple seed rounds. They're doing close after close, bridge after bridge, of these early angel type investments, often going on for years to keep the business running until they can produce enough results, enough milestones, enough growth to potentially interest those A-round investors. Or they get to a point where they can bootstrap the company, where they've now gotten enough investment in that they can just sell and grow organically and eventually return the investment of those angels. And without the dilution of the later rounds, even if you're not hitting the kind of home run and creating a unicorn company that would interest the venture capitalists, it can actually be a very successful outcome for the angel investors. In fact, that's exactly what happened to me. Way back in the 90s, I started the company. I thought I was going to do exactly this thing. I was going to get the angel investment and then get venture capital and then go to the moon. But I didn't have that kind of growth rate, at least not early on. And so I ended up on the treadmill of getting angel investments. And at the end of the day, I raised about $2.5 million, all in these small tranches from angel type investors. And when I finally did pivot the company and achieve success and get the kind of growth and margins that I needed, at that point, I was throwing off money and really didn't need the venture capitalists at all. Many companies may just never find themselves in the right place for a venture capital A round. They're never going to hit all of the metrics that those investors want to see. And so they'll stay on that treadmill of small investments, which may be fine. In fact, not getting that big investment can often be a great outcome for the angels as long as the company has a good exit. It doesn't need to be a unicorn because there's been so much less dilution. They can see really good returns from even a much more modest kind of success. And it may just take time to get to the right place. You may need to pivot to a new kind of business, a new direction, a new strategy to get the growth you need. Or it may be that your timing is wrong and you just need to survive until the stars align for you. And if you can see that time in the future, it's not worth holding on forever just out of blind hope. But if there's reason to think that in a year or two, the situation will be such that you will be able to get the traction that you need. Some new technologies coming out, there's some new trends in the way markets are behaving. Then just surviving may be all it takes to reach the point where you can hit that growth and either get the A-round investment or simply ride the revenues to where you need to go. So getting that investment isn't the only path. And it's important to design your business to be able to survive without it because, as we're seeing over and over again, a lot of companies have to do it. They're just not getting that A round that they thought they were going to be able to. Thanks for watching this episode of Fill the Boot. I hope you found it useful and interesting, and if so, do the usual like, subscribe, hit the bell, but most importantly, I hope you'll share this with other founders. I'm trying to create a community of entrepreneurs to make us all as successful as possible. If you like content in written form, please come to feeltheboot.com, where all of these episodes are available as blogs. Or if you like to listen on the go, we also have podcast versions of every single one, available on all the usual podcasting platforms. Till next time, ciao.